Morning, ladies and gentlemen. Welcome to Mazars and our presentation around governance, risk and control. This morning, we've got a little bit of an update for our clients and colleagues around some of the key considerations for fraud risk and internal control environments. We'll give it a minute or two. Well, no, we will probably get started because we're right on time. So first of all, let's kick into a little bit of a session agenda this morning. So the first thing we'll do is we'll make some introductions for everybody. That'll cover off, me, Mazars, a few things like that. Talk about some of the things that we're going to talk about today. We'll talk about governance, then we'll talk about some internal control, and then we'll finish up with some things to think about for fraud and fraud risk management. So a little bit about Mazars. We're a multinational firm. We have some fairly basic values that we do guide our work by, and those are set out here. We're represented in several countries. I think 90 odd plus was the last version I had seen. And I think that'll show us here 90 different countries around the world, 44,000 potential professionals who can work on your work through Mazars. So a little bit about me today, and I guess this is my opportunity to introduce myself to everybody that's on the website today, that's on our webinar today. I'm a partner with Mazars and I work in our audit and corporate reporting spaces. So the sorts of things I cover are corporate transactions. We deal with valuations, independent experts reports, investigating accountants reports, and of course, company audit reports. My experience covers a substantial portion of the Queensland economy. I started off working in New South Wales and then moved to Queensland earlier on in my career. I also sit on the Council for Queensland for Chartered Accountants, and I'm a National Counsellor for Chartered Accountants. I'm the Queensland representative on our National Council, and I've been a director for several years as well, including at what was Mullaney Credit Union once upon a time. Obviously, it would be inappropriate of me to make these presentations without also drawing attention to our general advice warning, which is that this is, of course, general advice. And if you'd like more information, please reach out to one of our staff so that we can give you a little bit more personal advice. So today's objectives are to talk about governance, to define what we mean when we talk about governance, to give some examples of internal control and how those are established, and to talk through some of the typical internal control weaknesses that we see when we deal with clients' files. So let's talk about governance. There's quite a number of different definitions of governance. One of the first ones that you see here comes out of the AICD, and this one talks about it's the processes put in place to monitor, control, and to govern an organisation. Then we have one from the Governance Institute, which again is about systems of control. We move through to a G20 or an OECD definition, where it's about, helping to build an environment of trust. And of course, you can go past that to the Committee of Sponsoring Organisations of the Treadway Commission, where their publications talk about why and how governance enhances the operations of the businesses. I think for me, one of my favourite definitions is this one that we see here, which is the definition of corporate governance that's used in the ASX corporate governance principles. Pardon me for a minute, I'm just going to shuffle around slightly. So the definition of corporate governance that's used in the ASX corporate governance principles is very much one about systems, the frameworks of rules, systems and processes within which and by which authority is exercised and controlled in an organisation. Now, the ASX corporate governance principles are available on the ASX website in case you're interested in getting that latest 4th edition version. We also see governance defined often in the ACNC work. And this presentation, it does have a little bit of a not-for-profit bent in it, because one of the things we're trying to do is to provide our clients in the not-for-profit space with a bit of an understanding of some of those resources that are available. So governance in the not-for-profit space is supported by the ACNC, which is the Australian Charities and Not-for-Profits Commission, and I'll talk about them in a moment. The ACNC provides several really great resources on their website around governance, and I would encourage anybody who's working in that sector to have a look at that system coming out of the ACNC. We've also got some resources from the Australian Institute of Company Directors, and that's a pretty good principles-based system that they've got. And those resources are available on their website. So let's talk about the ACNC for a little bit. Established by the Australian Charities and Not-for-Profits Commission Act in 2012, and what it did was take on the regulation for charities in Australia and take that regulation out of the Corporations Act to a degree, and take that regulation out of the purview of the Australian Securities and Investments Commission. The ACNC, being a special purpose regulator, is designed and implement and instituted to assist with that regulation of that charity space, because charities are a little bit different. We see that the ACNC defines a responsible entity, and the way they do that is in that section 205-5. And the responsible entity, whilst the term responsible entity is used, it will often mean the organisations that are working with a charity, and it's usually people like the directors or the committee of management, those sorts of people. We see the Act obviously set up in 2013, and there's a regulation as well, and the regulation that goes with the Act is quite an important piece of regulation, mostly because it establishes the register, and it also sets out the governance standards. And what do I mean by the governance standards for the ACNC? Well, the governance standards are fundamentally these 6 standards that were set out in the regulation as being areas that the ACNC, or that government wants the ACNC to focus on. Now, there were originally only 5. The 6th one was added last year, I think it was. And so the 6th one is a new one. Let's go through each of these governance standards briefly. So first of all, we have the purpose and not-for-profit nature. Obviously, you can't be a charity if you have a for-profit motive, if you're working to benefit your shareholders. So ACNC entities, charities, they work for the public nature. They have a not-for-profit nature. They have to be accountable to members. Usually this is dealt with via the annual report and the annual general meeting, but there may be other functions that we have. They have to comply with Australian laws, and there are various laws that require compliance, probably more than we give credit for. So legislation and compliance is definitely an area that we want to understand if we are working as directors or as senior managers in any organisation, including charities. All right, let's go our next one. Suitability of responsible persons. The ACNC standards set out obligations for organisations to ensure that their directors are appropriately qualified and suitable to be directors of a charitable organisation. The ACNC standards set out certain obligations for responsible persons. And so that's those duties of responsible persons. Sorry, I'm just going to get that right. And the duties of responsible persons come back to the common things that we used to see in the Corporations Act, areas like act with reasonable care and diligence, act honestly, fairly, and in the best interests of the organisation, not misuse your information, not misuse your position. And then finally, we have maintaining and enhancing public trust in the NFP sector. And this one includes various matters, some of them related specifically to the Royal Commission into institutional responses to child sexual abuse, and the way those organisations now respond to those outcomes and participate in the national redress schemes. So how do we as organisations, how do we respond to those NFP requirements that are set out in the governance standards? Well, there's obviously plenty of policies that you probably need to have in place. And what we would suggest is that you have at least some of these policies, that you should look through those tools and templates available on the ACNC website and make sure that you've got those set up in your policies for a not-for-profit entity. Now, there are several lawyers around town who will assist you with those if you so choose. So the duties of the responsible person, well, as I talked about briefly before, they're very similar to the ones that we saw in the Corporations Act. And the Corporations Act had those duties around acting appropriately, professionally, in the best interests of the organisation with care and diligence. So we'd recommend that anybody involved in a charity, pays attention to those matters and is aware of what your obligations include. I think I've got a book here. You could write a book about the basic director's duties, and I'm sure there are a few floating around, but I won't go into those today. All right, so working our way through, we've talked a little bit about governance. Let's have a bit of a chat about controls. And what I wanted to do here was set out some of the things that we would typically see with controls. And these are the sorts of things that if we're doing an audit assignment, these are some of the things that we will start to look our way through. So let's define internal control as a starting point. So internal control, and this definition comes from the Committee of Sponsoring Organisations of the Treadway Commission. And that acronym gets shortened to COSO in many cases, and we'll see and define that shortly. But internal control is a process affected by an entity's board of directors, management and other personnel designed to provide reasonable assurance regarding achievement of objectives relating to operations, reporting and compliance. We see that definition, we see that there are many different frameworks for control. And the one that we're specifically going to talk about today is COSO. But there are others out there. There's the Basel framework for banks. There's the ISO framework, the International Standards Organisation framework. And you might have heard of things like ISO 9001, which is the quality standard. COBIT is an IT control framework. ERM is for enterprise risk management. And the ASX corporate governance principles is another framework that we might talk about. But today, we're going to specifically dive into the COSO framework. So COSO, as we talked about, comes from the Committee of Sponsoring Organisations of the Treadway Commission. Established in 1992, COSO set out a certain framework as to how to think about controls. It is widespread in its thinking. It has gained widespread acceptance as a flexible but complete means of establishing controls in an organisation. And I think, interestingly, COSO forms the very framework, the very foundation for risk assessment for auditors. So when auditors come and talk to your company about how you run your control framework, the auditors will have been trained and will be thinking in terms of the underlying elements of the COSO framework. Now, the COSO framework can be thought of a bit like a Rubik's Cube in terms of there are certain control areas that we want to deal with. Those control areas will cross operations, reporting and compliance, so there'll be a divisional approach. And then they also apply at the top level of the organisation. They apply in divisions, at operating units, and even down to a functional level. And so that COSO Rubik's Cube is something that we'll see a little bit more. Now, this little chart here and this graphic on the right-hand side is available to download. And if I can just take this, now this isn't going to show up, but you can download it and you can print it off. This little graphic is great because it's got the 17 fundamental elements of the internal control framework that COSO puts together. And again, they go through those 5 components of internal control, starting with the control environment and your risk assessment, working through control activities and information and communications and technology, and then looking at our monitoring activities as the final element. So when we look at our internal controls, we typically look at those control framework elements and we break those down into our business cycles. And that could be things like purchase to pay or expenditure cycle or payable cycle. There's a couple of different words for it. Could be your quote to cash cycle, which again comes into your revenue cycle or your receivables cycle. We would typically also break those cycles into payroll and provisions. Fixed assets, inventory, and treasury are probably the main cycles that we would look at. So it can help when you're thinking about your internal control environment, about taking that broader topic and breaking it into each of those individual components that we've been talking about. One of the areas that typically comes up in control frameworks is the maturity of controls. So maturity of controls is a process that was founded in the early 80s with the Department of Defence. And it initially focused on software development, but that process maturity has expanded from that initial IT focus or software development focus and is now used in almost every area in business. Now, this particular maturity cycle or maturity graphic we've obtained from one of Gartner's presentations, and this is the Gartner maturity model, whereby you start at an initial what we might call ad hoc or beginning or developing area, and then as things get more developed, they become written down and they become optimized a lot better. There's some great resources. Michael Hammer did a process audit tool frame, and that was set out in a Harvard Business Review article from over a decade ago. What we've got here, 2 references that you're welcome to click on when you get the presentation and go and have a bit more reading about COSO. So let's talk about how we might document internal control. So documenting internal control, and I guess I'll just take the opportunity while I'm here, having gone through a good chunk of it. There are the quick Q&A, and we will have a little bit of time for Q&A at the end. So if you've got any questions, feel free to pop them in the Q&A. So documenting internal control, let's talk about how we would go through that process. Now, the first and most basic approach to internal control documentation is simple free-form text. And so I've got a nice little example here about, bank reconciliations prepared by XYZ on a monthly basis, et cetera, et cetera. So nice and easy. That's one way you could document your internal control. There are other approaches. We often see memos done up to how to document internal controls. Now, what I would like to do is give ISO 9001 a plug. We do have some clients who go through the process of implementing ISO 9001. So ISO 9001 is a quality control standard that is implemented by the International Standards Organization. One of our clients, CAS, Compass Assurance Services, I think was the proper name. They can help you if you need assistance with your ISO 9001 accreditation. And of course, being a client, I'll give them a plug when I get the opportunity. So their link there is there as well. Let's talk about control self-assessment. There are other ways to document controls. One of them might be in an Excel file, as you see here. And if you do a little bit of searching on the internet, you'll come across plenty of examples of internal control documentation. You may even very much find this worksheet. Who knows? The other options are you can do some flowcharts, and this is an example from a previous report we did where we sat down and mapped out the internal control environment for an inventory cycle. You could very well do some flowcharts. Here's a very basic flowchart done in Visio. Here's another one, and this is more of what we might call, or the business analysts would call, the swim lane, in terms of there are different elements set out, and so each lane has certain things done in it, and what you should see is that things will move from lane 1 through to lane 5 as we get through to the end of that process. If you wanted to, you could even do your controls documentation on an iPad. And this particular one comes out of Process Modeler, which is an application you can get on your iPad. Even if we have to, we can do them up in an Excel file. Excel's a great little tool to do process maps in. Excel and PowerPoint are two great little tools if you want to do a very basic process map. When we go through a controls review, we would typically set out a review process something like this, whereas we will start with a phase of understanding a cycle, identifying and assessing risks and controls, and then we'll go and assess the controls and do other things. And so those are the sorts of things you can get when you're working through on a controls assignment. And of course, as auditors, we can't help but occasionally we will identify control issues, and we'll identify them in our management reports, as we did here many years ago with a client where we were walking around their warehouse and there were some issues with the way inventory was stacked. And so we identified that for the board in our management reporting. One of the things when we're dealing with control is about monitoring continuous improvement. Organisations will have lots of different control issues occur during the process of their life. One of the things that we suggest is that you should have some sort of internal control or improvement register. Now, for those clients who are working with financial services, you will absolutely have these, because you'll have things like a complaints register, and a complaints register is the start of these sorts of audit registers. What it does is it provides you with an opportunity to document issues that are identified in the organisation and to track how those issues are resolved. There's a couple of, a Word or an Excel document will do it. There's a link there to some of the SaaS providers, so software as a service providers, who might be able to assist with that process. Here's an example of an Excel file that we've previously used with a client. And so this was, again, an opportunity to document where information was given to the organisation, where that information came from. So was it an internal audit report? Was it an external audit report? Was it a specific review? Identify what issues were being reported to the board, and then track status and priority and how things had been managed through. So let's talk about some practical application here. So we have some common issues. Now, we presented to a client a few years ago, or a client group a few years ago. And one of the things was, when we presented, we talked about, what are the big issues that your organisation sees across the broader organisation? And their CFO came back as the 10 audit items that commonly pop up. And so we've listed those there for everybody, because, of course, if those are the 10 things that auditors are commonly reporting across this organisation, and it's a broad distributed organisation in a school environment, so lots of different schools, and so if you can address these, you'll be ahead of the curve. So there's some really great questions to ask as we work our way through these controls. And I always try and encourage my auditors to sit down with the CFO and talk about, well, how do you know, and to ask these questions. How do you know creditors are not paid twice? And so I can see that we've got definitely some attendees on the line today. And my question to you would be, well, how do you know creditors aren't paid twice? How do you know you do invoices for all of the revenue you're owed? How do you know company credit cards are not being abused? And dealing with those things comes back to understanding the control environment. So then the other questions that we might ask are things like, how have you documented your internal controls? How have you documented your business risk assessments? What we find is in the smaller clients, often business risk or risk assessment will be a very ad hoc process done based on an intimate understanding of the business, and it's not so much based on a written framework that enables the organisation to respond, to identify and respond to risk. Let's start with design and implementation of controls. Well, a good place to start is a policy for policies. So how do you, a policy that sets out how you will develop, implement and approve your policies for the organisation. And then you might go into looking at your segregation of duties. Now, the basic rule that auditors always apply is going to be something like the people who have responsibility for custody of assets shouldn't also be responsible for recording of those assets. And that same basic principle of, trust but verify applies throughout the organisation. Now, that can be quite difficult in smaller not-for-profit and smaller commercial organisations. One of the three things that I always get my team to look at are those three things on the right-hand side here, where we're talking about, well, who reviews the financial information that is presented hopefully on a monthly or quarterly basis? Who reviews the bank reconciliation? So who's making sure that that fundamental control in an organisation is in place? And then who's reviewing and what control do you have in place over money leaving the organisation, so over disbursements? And we'd be very careful and recommend 2 signatories for all payments, both EFT and cheques. Payroll fraud. So here's a couple of examples now that just to stimulate the discussion. Now, of course, these presentations are typically done, or I normally would do these presentations in a meeting room here in the office. Doing these online in a webinar makes things a little bit more difficult in terms of we don't have that same backwards and forwards. So if you've got a comment, feel free to pop a comment in the comments or a question. We can deal with both of those. And we will certainly do so when we get through to doing, to finalising this and putting this up on our website later on, this presentation. So here's an example we had from a previous client where the client was a not-for-profit that operated a childcare centre. And the director was the sole signatory and processed all the payroll. And so what we found when we got to doing one of the audits was that there had been an increasing amount of overtime being paid. And when we worked into that a little bit more, we identified that actually she was paying herself overtime, which as the director wasn't appropriate because her contract didn't provide for it. And then on top of that, there were gift cards being purchased that were described as being gift cards to be provided to customers. So if families had an issue with the service, they were allegedly given a gift card, whereas in reality, the gift cards were purchased by the business and then used by the director for personal use. So that basic rule of segregation of duties, that trust but verify principle, may very well have prevented that fraud from ever occurring. Another example we get, and this is a more generic process, is to understand that the not-for-profit sector is a very high trust environment. And I've seen that with my not-for-profit clients previously, where there's an expectation that people who are doing good work, who are doing, people who are doing God's work, as one of my clients once said to me, that they will be very honest and trustworthy. And that's not a bad issue. It's not a bad assessment and assumption to make. But unfortunately, what we see is that in those high trust environments, that it's very easy for the not-for-profit sector to be targeted by people with malintent. And we see that happen because the not-for-profit sector is one of the few sectors where there can be very high cash balances. There can be very high investment balances. And there are plenty of cases where trust is misplaced. Any of my financial services clients, and I do a lot of financial services work, any of my financial services clients will understand that we constantly see ASIC acting against people who have tried to defraud people of their money. So it's the same risk with the not-for-profit sector. Now, interestingly, the ACNC identifies this as a risk, and you'll see there that they have a specific guide around fraud in not-for-profit sectors. So some more reading for everybody on the call today. The not-for-profit sector, it's a high trust. So here's another example of where these things can go wrong. What we saw here was, an audit of a school. The accountant had been engaging us in a systematic fraud over many years. And the way that was done was a simple invoice fraud of invoices being processed twice, the first time correctly, and then the second time to a bank account with different banking details being into the accountant's personal account. Again, high trust environment without a lot of verification. One of the things that we typically see, and this was number 5 on the top 10 from our school client from many years ago, is around expenditure delegations. And so there's often a lack of policy that sets out who can do what. So one of the first things that we'd recommend for all organisations is to review that expenditure delegation or that authorisation policy and have the board sign off on that again. Make sure you've got a credit card policy in place, a credit card policy that simply says, no, you can't use your business credit card for personal purposes. And if you do, you have to reimburse those expenses. And having that signed by people who have been issued a credit card, well, that's a very important factor from your corporate governance environment and a great way to prevent fraud. The number of credit card, the credit card cases that we've seen occur in the press, I won't dive into each of them specifically, but there's been plenty. You might have an authorisation, something like this, and this is one that I pulled out of our purchasing policy, which says, partners can authorise things, staff can authorise things, but only up to certain thresholds. We see other examples where we have a purchasing and payables policy, and these are our internal policies that we use to manage our fraud risk here at Mazars. We'd recommend similar sorts of policies for what you're dealing with. Now, banking. Banking is number 1 on our clients' top 10, and I'll dwell on this for a little bit. There's so many things that can go wrong with banking, and being number 1, what we typically see is that it's poorly set up with the bank. And unfortunately, I still see clients today who have one signer or one approver on some bank accounts, and what that does is open that account to potential fraud. So you should always have 2 signatories on an account. You should always have good quality password security, and you need to have your IT systems checked and updated. And that's probably a topic for another day, but we might come back and look at that one later on. One of the questions we'd ask is, well, what happens with your ABA file? So the ABA file is the file that's generated from your accounting software, which is the instructions to the bank about who to pay and how much to pay. And the question is, well, how does that get dealt with? How is that information transported? Is it available to anybody in the organisation, or does that file go to a secured location between your accounting system and your banking system? I do put a little warning here, and this is about phishing or spear phishing. Requests from the CEO, if I can put that in commas, requests from the CEO for immediate payments is a recipe for disaster. In fact, any request for payment received via email should be treated with caution, simply because it can be very easy for your your counterparty's email to have been compromised. So pay attention to that. And again, I'll go back to my earlier comment about trust but verify. Obviously, monitoring is an important element. And so we've talked about some of those monitoring controls earlier on. I won't spend too much time on this one. I've got a couple of notes there about paying attention to control accounts and subledgers. Suspense accounts and sundry accounts are also interesting, and then deviations from normal outcomes that should be investigated. So, a little bit of a to-do list for our friends on this webinar in terms of, if you finish this, can you go and check all of those to-do things coming out of today's discussion? The last part of our presentation this morning that I wanted to touch on briefly was fraud. And so this is really about bringing this to the forefront of people's minds. And again, today's presentation is about a refresher in some of the governance, risk and controls that we see, with some implementation around how we help prevent fraud. So let's define fraud. Well, the basic definition of fraud is gaining a financial advantage by deception. And, you know, there's different definitions. If you look at different legal dictionaries, you'll get different definitions, but that's fundamentally what it is. It's about gaining an advantage by deception. There's particular requirements in Queensland's criminal code, and I would imagine that those are replicated in New South Wales and Victoria. And let's bear in mind that Mazars operates across all the states. I'm just simply using the Queensland Criminal Code here because that was the easiest one I had available, and I'm based here in Queensland. We were fortunate to connect with Receipt Bank a couple of years ago, and Receipt Bank provided us with a bit of information about their fraud research, and I've replicated two of those slides here. The average fraud runs 18 months before it's discovered. 90+% of fraudsters are first-time offenders, and the average fraud costs, on average, $150,000 before it's identified and found out. So this particular slide pack from Receipt Bank had a couple of things about where small businesses are also particularly vulnerable, and I'll leave those for everybody. But for what I like to understand, and I think this is something I talk with my clients about, is the auditor's responsibility for fraud. And we got to understand that it's likely to be 150,000 or more before it gets picked up by the auditors. So we've talked a bit about fraud. There's a bit of more things that we've got there in terms of things to think about. How fraud occurs and what constitutes fraud. I think for us, you know, where and how does it affect organisations? Well, it certainly diminishes transparency. It undermines the reliability of our systems and our markets and our organisations. You know, and it causes stress for everybody who's affected in an organisation. I've seen organisations have frauds occur within them, quite substantial frauds, and the fallout can be quite significant. Little article here about why people commit fraud, and that's a great little read from a few years ago, so I'll leave the link there for everybody. When you get the presentation, you'll get the link. But we want to ask ourselves, who commits fraud? Management, employees, clients, suppliers, humans. Okay, humans commit fraud, which is where we come back to the trust but verify. In the audit space, we will typically talk about, and our teams have a fraud management discussion at the start of our assignments. We will typically talk about what we call our fraud triangle. Not ours personally, the auditors generally use the fraud triangle. So the fraud triangle breaks the fraud into a couple of different areas in terms of opportunity to commit the fraud, the rationalisation that, you know, why the fraud is okay to occur, and then the pressure to commit the fraud. What we would always typically see is that fraud happens via a debit entry. There's always a debit going somewhere, that somebody's not properly checked, and that's how fraud often gets hidden. So fraud, we typically split into two types of fraud. We deal with the misappropriation and the misrepresentation. One is often about, stealing, theft of assets, those sorts of things. The other one is a little bit more complicated in terms of it's dealing with financial reporting. And we, the auditor profession, have seen some massive frauds occur over the years. Let's take Enron as a classic example from 2001. Massive US fraud. The company collapsed owing billions of dollars, but it's not the only one. And the most recent one, I think, is that probably people would have seen would be maybe Wirecard. So they do happen. There's a lot of control. There's been a lot of changes in the accounting profession over the last 20 years to try and address some of these things. But we're not done yet because, as we've seen, the people who commit fraud are humans. I always like to use the example of the police service. If the police force had finished crime, had solved crime, then surely we could have stopped having a police force. But of course we haven't, right? We've still got police on the street because we're still worried about crime. Well, we're not going to solve fraud anytime soon. We still need the controls in place to address fraud. There's some particular indicators that we use, and those anomalous type behaviours and operational events are the sorts of red flags that we look out for when we're dealing with fraud. Safeguards, segregation of duties, independent checks, proper authorisation procedures, not having an adequate accounting system. Those are all the sorts of things that can create and create the environment in which fraud can occur. So my last little bit today is about responsibility for fraud prevention. And the question we want to ask is, whose responsibility is fraud? Whose responsibility is it to manage fraud? So here's the question. Whose responsibility is it? Management, auditors, or both? Well, when we're talking with our clients, we will clearly say management's responsibility is to manage fraud. And we recommend that you do that by having in place the things that we've talked about in our presentation today. We think that that's important because management have that day-to-day responsibility for the operations. And we've got some ideas here about how management can prevent and detect fraud. Now, the auditor's responsibility for fraud is set out in ASA 240, or that's Australian Standard for Auditing number 240, which is about the auditor's responsibility for fraud. And our responsibility comes into making a risk assessment, identifying potential areas where fraud might occur, making inquiries of management, and designing audit procedures to detect fraud, but to detect material fraud. And I think that's where you come back to that earlier presentation from Receipt Bank that we've given you two extracts from, where Receipt Bank had said the average fraud goes 18 months and costs $150,000 before it's identified. Well, I would humbly suggest that's probably because the first audit, if you're being audited, the first audit where the fraud is happening, it doesn't get identified because it's not material. By the time it gets to the second fraud, usually the thing has become material, and that's when the auditors would have identified it. And so that very much comes back to that traditional review of management's responsibility is to prevent and detect. Our responsibility as auditors is to work our procedures on the basis that there may be fraud occurring, and if we identify the fraud, to respond to it appropriately. But we're only going to be picking up material fraud, which is going to be a chunky number. So a little bit of a tip, a little bit of a to-do list for our attendees here today. Rethink fraud. if you think you've got a lot of cash sitting around and you might have people who, you otherwise would trust, maybe have a think about how you document and respond to that fraud. And as I said, we've got great resources with the ACNC, and I did pull out the QAO. Now, for those in Queensland, the QAO is the Queensland Audit Office. The QAO, very helpfully for the Australian economy, has a great little better practice guide, and it's a fraud risk assessment tool. So it's a little Excel file that you can go through and answer some questions and do your own fraud self-assessment. Ladies and gentlemen, that is largely my presentation today. I will identify and point out that we have offices in Sydney, Melbourne and Brisbane, and you're welcome to contact any of the offices about the things identified today. All of my audit partners in those 3 states can assist with what you've been thinking about. I have got a little question here about not-for-profit, small team. Any tips to strengthen internal controls for a small management team? Well, I think for me, I'd probably loop back to that earlier comment about having those 3 key controls in place. Now, I don't remember which slide it was on particularly, but it was the control slide around what you want to have is you want to have a review of the numbers regularly. You want to have preferably 2 signatories on all deposits going out, and you want a review of that bank reconciliation regularly. Those would be the 3 areas where I'd definitely start. If there's got any other questions, ladies and gentlemen, feel free to drop them in the Q&A box. We'll be finishing slightly earlier today. As I said, this is normally done face-to-face, so I would normally be, there'd be a little bit of backwards and forwards, and without that, it's a little bit more difficult. So we'll be finishing probably 5 or 10 minutes earlier this morning. Again, just to touch on Mazars, who we are, what makes us different, and again, our values. So I'll leave it there. Thank you very much. I'll give it a minute for any other final questions or comments to come in, and I'm just having a look on our screen here, and I don't have any others, so we'll leave it there and call the presentation. Thank you very much, ladies and gentlemen. Have a great day, and we look forward to talking to you again.